Hello, hello. Welcome to another episode of Financial Tides. Today we're going to be talking about when doing nothing is actually the smartest move. So, I'm your host today, Taylor Perillo, certified financial planner. And today we're going to talk about something that feels counterintuitive. It's the power of doing nothing. We're in a world where we're constantly told that we need to take action, we need to make moves, we need to try to stay ahead. So it's going to be uncomfortable to try to feel like you need to sit still. But sometimes, especially when it comes to your finances, the markets drop, headlines get loud, everyone seems like they're making moves and doing something, and you're going to be urged to react, and that presence is going to be strong. But oftentimes, the smartest move you can make is taking a pause, sitting still, doing nothing, exploring what options you have and not reacting to immediate calls to action. So let's talk about that. So, why is it that we feel the need to react? And I think that there's a lot of different things. And we always tell clients that we're more than just money managers. We do more than just financial planning. We feel like the biggest thing that we can bring value to is that psychological part and kind of helping you be in your own way and kind of get in the way of your own need for immediate action. And that immediate action comes from the way we're wired as humans, our psychological need to do something when uh, calls to action, fear, emotions come into play. So, investing really rewards patience, not panic. So, another one of the quotes you'll always hear us say is that the stock market is the greatest invention um, to transfer wealth from impatient people to patient people. So that's Warren Buffett's mentor's quote. It's not my own, but we do feel that it's very pertinent and very important to think about when you're thinking of why you should wait. So it's really a patience game, and that's where the behavioral finance comes into play, and it comes into play because of emotions. Our brains hate things like uncertainty. When we see losses or a scary news headline, we want to do something. You want to know why? Because it puts the illusion that we have control in our head, that we can do something, we can take some action. And that's not necessarily true. We can't control what the market does on an ongoing basis. And just taking action doesn't mean we're in any better control of it. It just means that we did something different. So it's an action bias. So that's feeling like doing something is better than doing nothing. Sitting by and watching your portfolio go down feels like it hurts more than sitting there changing an investment around and watching it go down anyway. You feel like at least you tried to do something, when in reality that's not really doing anything to help your case out. So the action bias is basically saying that we need to do something because feeling like we're doing something is better than nothing. So even if it's hurting the result, we're going to want to take some sort of action. We're going to want to feel like we're doing something, instead of just watching your portfolio go down. Even if you switch investments around, make moves, it's not going to necessarily better your situation. But in your mind, you feel like you're not sitting by and watching your investments go down. You feel good because you're doing something about it, even though that's not the reality. So, this can show up in many different ways in real life. And I think the number one is just selling investments when the market dips. So you turn on the news or you watch your investment account, and day after day, the markets are going down. And you say, I have to do something about it. I can't let my investments go down. You feel like you're regaining that control, and you make moves, you make adjustments. Maybe you put it into cash, but that doesn't necessarily help your long-term outcome because now you have to figure out the best time to get back in if you went to cash. Or if you're just switching investments, maybe those investments are ones that are poised to go down more, even though they went down less in the past, just because they haven't really experienced their dip yet. So, we think making really drastic changes and updates to investments just because of the market dipping is one of the examples that we see it happening in frequently. The other one is making changes off of news headlines. So many times, whether it's an election whether it's global news, a war, bombings, different events can tug on different heartstrings and different emotions for people. So people feel like because of something happening that they need to make a drastic change just to kind of control it. So a big example of this, actually, I'll save that example for a little bit later, but there's plenty of examples just of negative news creating it. We have something that we show to clients often called the wall of worry. There's always a negative news headline, and there's always something to be fearful on, and different things will trigger people in different ways. So that's one of the ones that causes people to do something when they really should be doing nothing. The next one is jumping in and out of investments and trying to time the market. So going in and out of the market, we always say it's not the timing of the market and trying to be perfect on when you're getting in and out. It's time in the market, meaning that the longer you're invested, the more compound interest you can take advantage of, the more markets that you can, volatility that you can go through because you have a longer time horizon. So time in the market more important than timing the market. But again, timing the market, people feel like they have that element of control and often shoot themselves in the foot trying to be perfect, trying to find when the bottom is, buy at the perfect bottom, then they miss. And then they are afraid to get into the market again because now the market's at all-time highs, and it's too late for them. So the irony of all of this is that wealth is built by staying invested through volatility and not really predicting what happens next, but our brains are wired to do the exact opposite. So let's talk about some times when doing nothing worked best in the past so we can kind of look at it as a case study. So long-term investors who stayed the course through turmoil have came out ahead more often than not. And even some of these more recent examples, you're seeing it was a very short recovery time. So let's talk about the longest one in recent history, the 2008 financial crisis. Markets dropped over 50%. People were scared for rightfully so. If you had $1 million and 50% down, you now have 500,000, you're going to feel like you have to do something. You're going to be scared. You're going to feel like your wealth just got cut in half, which is exactly what happened. And the people that weren't patient and the people that decided they couldn't do it anymore and they needed to do something about it sold near the bottom and they missed the recovery. We know that markets are getting right around all-time highs again right now. And all the people that sold in 2008, when the market did recover about a year and a half later, their 50% was back. The people that were impatient sold off and had no money to recover. Quicker, 2020 pandemic. Markets sold off 34%, so about a third of your wealth was gone in just a few weeks. People who held saw the full recovery in less than 6 months. So we all know that even though the pandemic stretched out, the pandemic crash didn't last nearly as long as the actual pandemic. So we know that anyone that held on and said, instead of chasing that news headline and saying, hey, everything is closed, how are things going to make money? How are people going to buy stuff if they're not going to go out and consume in large quantities because we're all locked in at home? That was the initial knee-jerk reaction. Market sold off 34%. People got fearful and panicked, and it was a confirmation bias. So the people that said, hey, this is scary, we're going into a pandemic, they got confirmed that it was scary because everybody else was selling off stocks to create that 34% dip in the markets. Meanwhile, everyone that said, hey, this is scary, but it happens sometimes, people get afraid. And once somebody starts selling, more people continue to sell. We just have to let it recover. Those people were rewarded with all-time highs shortly after. Next example is just ongoing volatility in general. So this is what's going to come up in the future. You're going to hear a lot about interest rates. You're going to hear a lot about inflation, which we've heard about already. And then there's always an election coming. It's always going to happen every 2, 4 years, and even some smaller elections and off years. We just had one, which didn't have as many elections, but there's always something to be fearful of. There's always a political party that you're not going to agree with that's going to be in power or going to be in charge somewhere. So these cycles happen regularly, is my point. And not reacting to every headline and giving yourself whiplash, going back and forth, trying to figure it out, is going to be more important than trying to figure out what you need to do just because of all these headlines. And these headlines are designed to make you want to react. They're designed to keep you engaged, make you take action so that you can come back and confirm and keep watching their news channel or reading their news articles and confirm that you took the right action with the next story and the follow-up stories. So, really, who's benefiting there? It's the news outlets that are providing this information. So, the big takeaway is that the markets reward the time in the market, not timing the market, at the end of the day. So, what does doing nothing actually mean? A lot of people will confuse doing nothing with sitting on your hands, ignoring your finances, but that's really not it. It's really more about not making the emotional decision, not reacting, than it is that you're sitting on your hands and ignoring it, putting your head in the sand. So this doesn't mean being passive. It means being very intentional about when you act and why you're acting. So the big questions that we typically ask to make sure that you're not doing something emotionally or knee jerk usually has to do with goals and time horizon. So we'll revisit your goals with you and say, hey, what has changed in your goals that makes you want to be invested more conservatively if you're trying to sell off during a stock downturn? Because if your goals haven't changed and your time horizon hasn't changed, your money probably doesn't need to change. And that's where that intentionality comes into play. We're going to review emergency funds and cash to give you peace of mind. So, knowing that you have a good cash fund or a good emergency fund that if something does come up and you need to pay for it, you're not selling stocks while they're down and that you have a chance for it to recover. And then just having that general conversation because emotions are things that once you share them and you voice them, it doesn't feel like you're carrying them alone. It can help take a lot of weight and a lot of pressure off you to know that somebody else has heard it, understand it, and can walk with you through that fear going forward without having to make changes. So let's talk about when doing nothing might not be the right move because we talked a lot about when it is the right move. So there's a difference between staying disciplined and staying disengaged. So I think it's important to still be involved, still understand what's going on. But when you have something like a major life change, whether it's marriage, a new job, inheritance, retirement, your goals are going to shift, which means your time horizon might shift as well. So I think it's important to then, with those things, engage with us, take action, and figure out ways to make sure that your portfolio gets back in alignment with your new goals and your new time horizon. It's important to avoid that in confusing inaction with avoidance. So you don't want to think that because you're not doing anything that you're just avoiding it and letting it do its own thing. So you want to make sure that you're not avoiding updating just because something changed, but you feel like doing nothing is better because everything is working well. So that's more of the avoidance of, oh, everything's working well, I'll just leave it. You still want to be taking action when it's necessary. And then important updates like rebalancing your account, getting your account back in your risk tolerance and back to where it should be aligned with some of your goals is always important. And then tax planning. So you don't want to avoid making changes that will possibly help your tax situation just because everything is working fine. There's always opportunities that we will be bringing up or you can find and bring up to us, and we're happy to help with those. So, at the end of the day, like everything else in life, it's always about having a balanced approach. So, you want to make adjustments based on strategy rather than emotion. You want to schedule regular reviews, which we do proactively. And you want to avoid day-to-day tinkering. Nothing is going to be changed on a day-to-day basis. Your goals aren't going to change. You don't need to be looking day to day. You just need to build confidence in that stillness, confidence in the approach you have. And I think that the strategy that we help clients with brings a calmness because they have trust in their plan. So it's really time to just reframe your mindset. View short-term volatility as part of your long-term journey. It's going to happen, and you just have to know that it's normal. It's not dangerous. It's how money gets made, and volatility, you see everything going jaggedy, and that's just what actual normal markets do. If you ever see something completely flat, I would say that's just as dangerous, mainly because the completely flat line, the lack of volatility, often doesn't keep up with inflation. So, in conclusion, sorry, doing nothing goes against our instincts. It's gonna feel better to feel like you're doing something, but really in investing, restraint is your superpower. We can help you with the restraint side of things. And when the world feels uncertain, remember, markets tend to recover, fear will fade. The things that are in the news headline right now that are scary aren't going to be there forever. There will be something new to be scared about, and those who stay the course will come out ahead more often than not, and those who react will impair their long-term wealth. So the next time you feel the urge to do something, take a breath, let's revisit your plan, and just remind yourself that sometimes doing nothing is doing something, and it's protecting your long-term success. Thanks so much for tuning into this episode of Financial Tides. We'll catch you on the next one.
Cool. Sounds good.
Perfect. Thanks, Josh.
Thank you.
Bye bye.
John Perillo and Taylor Perillo are financial advisors offering securities through Cetera Advisors LLC, a registered broker-dealer, doing insurance business in California as CFGA Insurance Agency LLC, member FINRA/SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera firms are under separate ownerships from any other named entity. California insurance licenses number 0F60123 and 0M90666, 6265 Greenwich Drive, Suite 251, San Diego, California 92122. The views depicted in this material are for information purposes only and are not necessarily those of Cetera Advisors LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Advisors LLC nor any of its representatives may give legal or tax advice.